you for joining us today for the Financing Your Small Business, part of the Small Business Webinar Series. My name is Duke Wynn Abrahamson. I am the Executive Director of the Asian Pacific American Chamber of Commerce, also known as AAPAC. This year, AAPAC celebrates our 22 years of facilitating business relationships among Asian-owned and US-based companies and promoting the economic advancement of the Asian American Pacific Islander. Businesses owned by Asian Americans with heritage from China, Japan, Korea, Taiwan, the Philippines, and India, among other countries, Fortune 500 corporations, entrepreneurs, business professionals, cultural organizations and associations, and political and government dignitaries have supported AAPAC throughout the years and are the reason for our success. We are a collective voice of 30 plus Asian and Asian Pacific countries. We are able to do this through our strategic partnerships with Asian cultural associations throughout Michigan and nationally, and through our sponsors. So thank you to General Motors for supporting the AAPI small business community. Let me begin by introducing Laura Van Hoody, AAPAC's Small Business Action Committee Chair. Laura is a benefits consultant with Hub International and an employee benefits firm with 7 Michigan locations and serves both small and mid-sized businesses. Laura?
Sounds good. Thanks, Duke. Hi, everyone. I appreciate the warm introduction. As Duke mentioned, I'm Laura Van Hoody, and I'm the chair of the SBAC, which is a committee formed last year with the goal of really supporting the Asian small business community. And I'm super excited for everybody to join the webinar today, where we get to hear from Romy Ancog, a little bit about some ways that you can be involved with the Small Business Action Committee. Our main goal is to really serve the community through different educational events, such as our webinar today, through in-person small roundtables, and just overall supporting you on issues and legislative changes and things as a small business owner you'd like to know. So the way that you can help us is by telling us what issues face you, what knowledge you like to gain, and in what best format you like to receive those. So if at any time you have any questions or you would like to learn more, please contact me and we can set up a call. But with that being said, I hope you enjoyed today's webinar, and Romy, I will turn it over to you.
Hi, everyone. My name's Romy Ancog. I'm the lead export finance manager for the Small Business Administration. The SBA, we're here as the federal agency to help small businesses start and grow. I am a specialist here at the SBA focusing on international trade, but I'm a longtime banker and have been with the agency for going on 14 years now. So my entire career, I've been focused on helping businesses get financing. So hopefully I've got some good information for you today. I'd also like to invite Leo Tudela, the Deputy Director for the Michigan District Office. I believe he's on the call today. Leo, did you want to introduce yourself?
I do, and thank you, Romy. And first of all, welcome everyone, and thank you again, Romy, Duke, Laura, and AAPAC for just allowing me just a brief moment to have an opportunity to speak. First, happy Asian American, Native Hawaiian, and Pacific Islander Month. As an Asian American, Native Hawaiian, and Pacific Islander myself, I care deeply about our community. AAPI-owned businesses represent just a growing footprint in Michigan. And while we don't represent a large percentage of the people, we do represent a big outsized percentage of businesses. As I've had the opportunity to go around the state and speak to different Asian American business owners and leaders around the state, I've just been really, really impressed with the creativity, drive, and passion that I've seen. Our collective impact on the state of Michigan has been significant and will continue to be so well into the future. The Biden-Harris administration is committed to advancing equity and opportunity for AA and HPI communities across the country. And we at the US Small Business Administration, the SBA, will play a critical role in economic recovery and resiliency for our nation's small businesses, and especially for underserved entrepreneurs, working alongside with organizations such as APAC, which we value highly. We're really looking forward to being more and more involved. Just as Romy will inform you over the next hour or so, our financing tools are designed to enable access to working capital for those that may not be able to secure traditional loans from a commercial bank. But we also have a network of resource partners as well that provide free counseling services and technical assistance to small businesses for a wide range of needs. The APAC and the SBA, we really share a common dedication in supporting the AA and HPI businesses. And here at the SBA, we're going to be working very closely. I think, Duke, you and I have a meeting next Tuesday to talk about how we can interact more closely together. Welcome again, and please feel free to reach out to myself or Romy if you or your company would like more information about our programs, or just meeting with us and learning more about how we can support you. Thank you. Romy, back to you.
All right, thanks, Leo. And I'm a long-term. I previously, before my present role, worked at the Michigan District Office. It's a fantastic group of people that really are doing great work, helping small businesses grow. Next slide. So what we're focusing today, though, on is financing your small business. Next slide. This is an underappreciated part of business owning. Everybody's always focused on growing your business, getting the sales, doing the marketing. That's the fun part, Sometimes the hard nitty-gritty part is, where do I find the cash to keep everything going? How do I get financing to take on those new or larger contracts that that I'd like to, in order to scale and to get going? So really, let's step back a little bit and talk, though, just about general financing your business. And really, there's only two places that you get money from: equity or debt. Equity is your own money, or investors, people that own the business. All right. Debt, though, is so every small business has some level of investment by the owners. All right. That's the best way to, but not everybody has enough saved up, or has access to that of their own money. So you have to look to borrow the money, and and bank loans are the primary way that that small businesses look to get financing for their businesses. I'm going to be focusing on how to get financing from banks, how to get approved for a bank loan. I'm going to talk about the process. I'm going to talk about the criteria. What do they actually look at? And I'm going to talk about, if you're having trouble getting approved, how can we here at the SBA help, right? I sometimes refer to as, when I talk about equity versus debt, I talk about OPM, debt being other people's money. That's what the OPM stands for. Next slide. So what's important to understand about bank financing is banks are they're inherently different from investors. My sister loves to watch Shark Tank all the time, and I don't, because I do it kind of every single day. I'm talking to small businesses. I don't need to do that during my spare time, but she loves to watch it and loves to watch those sharks, how they evaluate it and how they decide when they want to put their money into these deals. Commercial banks don't do that. Commercial banks or credit unions, lending institutions, take your money, your deposits, your savings and checking money, and loan that out to small businesses, or and large businesses too. It's better to think that banks rent money to businesses. You go out and you need to rent equipment from time to time. You need to lease space for your business. Money is cash is another asset that you rent from time to time when you don't need it, and and you've got a gap in when you have and when you don't have cash. That's where a bank comes in. You come to them and you borrow this, you rent this from them for a time, and you pay a fee for that, and that's the interest. That's the cost of renting that money. So I just kind of want to give that perspective up front. Next slide. It's important to get the right lender, all right? It could be a large bank, Bank of America, Citibank, Hong Kong, Shanghai Bank. It could be a local bank or credit union, that's very small. Finding the right one for you is what's important. So, a bank that understands what your business is interested, that does lend to your industry. Some banks, not every bank lends to, does every kind of lending. Talk to your financial advisor. Talk to your colleagues. Talk to your competitors. If your competitor gets financing from a bank, that bank might be likely to lend to you also. It's not that a big bank is better. It's not that a small bank is better. Big banks are very efficient. Small banks are more invested in your local community, right? So that affects the approval process. Big banks have underwriters that might have signing authority. At one point in my career, I had $750,000 in signing authority at a local bank. I can't believe they entrusted me with that much money, but there are individuals that can sign off on that. Other banks might have a loan committee and a more involved process. Okay, like I said, different lenders have different expertise. Some are really good at automotive. Some are really good at real estate. Some are really good at high tech and at software. Okay, being nearby isn't imperative, especially with today's technology, but it doesn't hurt, And most importantly, you want to find somebody that's interested in what you do, that you can talk to, that has time to work with you. So the right fit is more important, and the right specific lender at the bank is more important than just the name or the reputation of that bank. Next slide. Really, there are only two kinds of loans at the end of the day. And it's important to understand the difference between them. You can get a line of credit at your bank, okay? And I hear borrowers interchange these. They say, I'm getting a loan or I'm getting a line. And I want to explain the differences between what a term loan and a line of credit are. A line of credit is a short-term loan, usually revolving, which means that, revolving means that you have $100 limit on it. You borrow $10, you only have 90 available left. When you pay that back, you have that money available again. That means revolving, okay? These loans, they work really similar to your credit card. And what you want to use these for is it's short-term loans for short-term purposes, working capital, okay? So that's accounts receivable, that's inventory, okay? That's a short-term need. You don't want, you wouldn't buy a car on your credit card. Well, you could, but I don't recommend it. You don't want to buy equipment or have long-term assets on a line of credit, as opposed to a term loan. Next slide.
Romy, I'm just gonna ask a couple of questions. So you talked about finding the right lender. And so a lot of small businesses, especially AAPI businesses, don't really know where to start. And they do look at the larger banks like Comerica Bank. And, where else can they start looking? What, if they don't know who to talk to and their competitors are like,
Sure.
Hey, I have my own investors. Who should they be talking to? Where should they be looking to find the right lender for them?
First and foremost, if you have a relationship with a bank at this time, start there, because you got a history with that organization. So, banking's like anything else. It's a relationship based. Start with your financial advisor, though, your accountant, your investment advisors. They probably know good bankers. Okay. Like I said, though, talk to, talk to your colleagues within your industry. See who they bank with, You can also come to the SBA. We've got a tool, called Lender Match, where, you can type in kind of what your needs are. If you go to just sba.gov, G-O-V, that's how you know it's us, because it's a government site, .gov. You can come type in kind of the basic information of what you are looking for, how much, your industry, where you are, and that will go out to lenders in that area, and lenders that are interested in talking to you will get your contact information and get in touch. That's called Lender Match. You can find that on our website, Lastly, if any member of APAC is having trouble, with any kind of financing, any kind of small business situation, they can reach out to me personally and I will work with them.
Thank you so much. Now let's talk
Yeah,
about
absolutely.
line of credit. I know a lot of AAPI small businesses use their own personal credit cards to finance their equipment or do rentals. So is it possible to get a loan to pay off those credit cards and start kind of anew?
You can, but it's tough. First of all, you've got to you got to show that those credit cards were used for business purposes and not for personal use. No bank, and the SBA, no bank wants to refinance your not with a business loan. All right, we're talking specifically about business loans, not personal loans or home equity loans. Those you could do it with also, but when you talk about a loan in the name of your business for business purposes, it's hard to refinance credit card or revolving debt or even a home equity because it's hard to prove that money was used specifically for the business. If you get a credit card, try to get it in the name of the business first, okay? And use it exclusively for the business. Don't take a trip on it. Don't take your friends out to dinner on it. Only use it for the business. That would be one chance. It's not unusual to see credit cards being used. It's really common. Credit cards are expensive, though. I know a lot of businesses that say, you know what, I'm going to run up. I'm going to get 5 different credit cards. I'm going to get $80,000 worth of credit on them. I'm going to run those all up and start my business. I've seen people do that successfully, and I've seen people fail miserably because you are then caught in an expensive. That's the most expensive financing you can get, And if your business doesn't start generating cash quickly and at high amounts, you're caught and you're paying credit now, and that's a trap you don't want to get into. You're really rolling the dice. I'm not saying it can't be done, but there are other ways, safer ways. I'm a banker. I don't take a lot of risk. There's safer ways to do this.
Thank you. I think that's important to make
All
sure
right.
that we highlight.
Absolutely. I've talked to thousands, if not tens of thousands of small businesses over the years. I've seen every single way that businesses find. And believe me, businesses can be incredibly creative. I'm amazed at the creativity of entrepreneurs, not just in what they're doing, but in how they find ways to keep things afloat. I stand in awe of the small businesses, and that's why I really love doing what I do. Let's continue to talking about the different types. So we talked a lot about credit lines, all right? But maybe you've got a larger project. You need to buy a big piece of equipment, or maybe even real estate, or maybe you want to buy, make a large investment in your inventory. You got a chance to buy a lot of inventory all at once. You want a term loan for that. Could you do this on a line of credit? Sure, but it doesn't make sense. Get a term loan, a line of credit is designed to be paid off in one sales cycle, ideally. A term loan is paid off over several or multiple sales cycles, all right? So, an intermediate term loan you'd use for equipment. A long-term one is a mortgage, for real estate, for example. I just want to highlight the different kinds so that when you're talking to your banker, you can impress them that you know the differences between these types of loans. All right, next slide. So, just to recap, the process to get a loan, there's several steps in it. And I want to make sure you have that language for when you're talking to your bank. My whole goal in this is to kind of demystify the loan process. Small businesses are really good at making their product, providing their services, doing what they started the business to do. Not everybody applies for loans on a daily basis, and bankers speak a different language. If I can give you that language and you can speak use those same kind of words, that impresses them and gives you a higher chance at approval. That's my whole goal. I want you guys out there to get approved for a loan. So when you come in, your first phase is going to be the application phase. They're going to gather all your information. You're going to provide them your request, your financial statements, your tax returns, maybe estimates for everything you're doing, cost estimates and projections for your business. They're going to take that all in. They're going to do credit checks on you as the owner. They're going to do a lot of financial analysis on your numbers. Okay, that's probably the first thing they do. Your banker, as soon as you start talking to them, I know this because this is what I do. They're going to start running numbers through their head as to the business probably makes this much. They'll probably qualify for X amount. Let's see if the numbers bear out when I start to look at it. Bankers just think in terms of numbers. So that's why getting a full package of information is important upfront. So then they can take it back, go through the approval process, and hopefully render an approval for you. You're not done though once you get that yes from the bank. Then you start due diligence, okay, verifying the things that they looked at during approval, all right? Especially, if there's real estate involved, they've got to do title work, they've got to do environmental work, perhaps they're verifying credit checks, perhaps they have to file UCC liens against the assets that you might have. Once all that due diligence is done, then you can move to closing. This whole process, depending on the complexity of it, can take 3 to 4 weeks. If there's real estate, 4 to 6 weeks. If there's SBA, added to it, maybe another week or two added to that. Take that time frame into account because you don't get money until you go through this entire process and get closed. A lot of people think that you can walk into a bank and get approved and get funded. It takes some time. Okay, so yeah, as I talked about, it can take 3 to 4 to 8 weeks for the entire process. Next slide. So I've kind of talked about the processes. Let me spend some time talking about what the banks look at once they get your information. How do they analyze the bank, and what are the factors that get you approved or declined on a bank? Banks, every single lending institution around the world uses these same principles, the 5 C's of credit. So these 5 factors go into every single credit decision for every single loan, and you could probably extend that to every investment decision out there also. The language, they might use slightly different characterization or language about this, but the principles are all the same. let's get into them and see what these 5 mean. First, no, next slide. The first one is character, and I would say character is the most important factor. Character is basically your willingness to pay back your loan, okay? It's also the hardest thing for a bank to evaluate. How does a bank know if you have good character or if you have bad character, you know? It's really tough, and it's really hard for you to prove. The only objective scales that are out there, you know, or the most important one is your credit score. Let me put this up front. I hate the credit score system that we have here, you know, in the U.S. I think it is incredibly flawed. I think that it has, you know, huge mistakes. You know, they're fraught with mistakes, but they're incredibly important. Every single bank and credit union uses them. We use them here at the SBA also. So, you know, because they are so flawed, it's more important for you to get behind them and to understand what's in your credit report. Everybody, every small business, every business owner should know what's on their credit report and should review it on a regular basis, at least annually. Here are the links for the major websites that are out there, and you can get a free one every year through annualcreditreport.com. There are other services out there that can help you with this. I'm not an expert on credit reporting, okay? So I'm probably not the right person. There are people out there, our counselors can help you if you have challenged credit. There are ways that you can go about starting to fix that. Beyond the credit report, how else can you demonstrate a pattern of repayment? You know, if you can get letters of credit, letters of reference from your suppliers or from other people in the community, and make sure your banker gets to know you. That's the only way you're going to really show them that you are of good character and you'll repay your loan. Okay, it's the hardest thing to prove. It's the most important thing, because if you don't have good character, that's a hard stop on you know, on any business loan. After you demonstrate, now you start to get into the real analysis of, can your business, you know, qualify for this loan otherwise. Next slide. The first thing they're going to look at, every small business lender is in the SBA too. We're what you call cash flow lenders. So the first thing we're going to analyze is, do you have the capacity? Do you generate enough cash flow to pay back this loan? And specifically, I'm saying cash flow. I'm not saying income. I'm not saying sales. Nothing, you know, you can't repay your loan with sales. You can't repay your bills with sales. You can only pay those with cash. So understand the difference between cash flow and just net income, all right? An important ratio or analysis, and this is something everybody can do on your own, is debt service coverage. So every single bank analyzes, can this business repay this loan, and the way, and that's called, do they have enough coverage, enough debt service coverage to to make this loan approvable. A good number for debt service coverage is 1.2 times. All right, that means the business has enough cash to cover all their debts and have a little bit of a cushion. That's at that 0.2. All right, so they can cover all their debts with some cushion. How do they make that calculation? Okay, I don't want to get too technical, but I think everyone can can look at this. Your business income, okay, I'm not going to talk about non-cash items like depreciation and things. Let's keep this simple. Business income plus personal income divided by your business debt, your debt payments plus your personal debt payments, all right? If after you do that calculation, you're at 1.2 times or higher, you are, you're likely to be approved or to meet this criteria from your bank. Our business counselors can help you calculate that, or you can go to your accountant or other financial advisors to help you with these kinds of calculations. But most business owners should be able to do this on your own. Next slide. So we've talked about you're of good character, your business looks like it can repay this loan from normal cash flow. Now the bank is going to say, all right, that's great. Are there enough assets? What assets are out there backing this loan? All right. What's going to collateralize or secure this loan in case the business can't, in case something happens and the business can't pay me back? I know they may want to, but things happen in the course of running a business, and the bank, the business may not be able to, and the bank might have to go in and try to recover its money. Remember, it's not the bank's money that they're lending out, it's your money, it's your grandmother's savings account that they're lending out. They have to be incredibly prudent with that money, so they need collateral. How much collateral? At least as much as your loan. They want a 1-to-1 ratio on that. And remember, the bank, how you value your assets is not how the bank values it. The bank is going to look at your assets from the perspective of, if they have to collect it and to resell it, how much are they going to get? So they're going to look at liquidation rates. So at a liquidation rate, are there enough assets to cover this loan? Okay. And if the business itself doesn't have enough assets, are there personal assets? Perhaps equity in a loan, perhaps equity in a home, or investment assets, or even cash that could also be pledged in order to support this.
Would equity in a business be considered here?
Just equity in another business? Probably not, because how does a bank get at that? The bank would have to liquidate that other business in order to get at that, the value in that other business. So unless you're talking about, readily saleable stock. So when you look at value of assets, it's is it something that could be leaned on? Can the bank actually take a good lien and take possession of it if it needs to? And B, can it be sold on the open market readily? Okay, so those are the two things you're going to look at when they're looking at your collateral. It's almost axiomatic that small businesses are under collateralized. That's just, that's just out there. So we'll talk about tools, and if you're a service company, you might not have enough collateral just by nature of your business. We'll later talk about tools that, and how the SBA can help cover that. Okay, next slide. All right, so we talked about you're of good character, you've got capacity to repay this. You've shown you've got essentially enough assets in order to collateralize this loan. Now they're going to look, does the bank think you're going to be in business for the long term? Do you have is your business well capitalized, or do you have enough invested into this business to begin with? All right. Bankers won't lend 100% on any deal. All right. And they want to see that you have some money into the business or into this project. How much you need to invest into it, you're buying a piece of equipment. Okay. How much do you need to put up? There isn't necessarily a hard and fast rule. More is better. Sometimes as little as 10%, sometimes as much as 20, 30%. So it depends on a lot of other factors, but I can tell you, you have to have some money into your project. You have to have some of your capital. Or the other way that capital is looked at is, how much do you have invested into the business? Have you retained earnings? Have you put your own cash into this? Or investors' cash. Okay, the better capitalized, the more capitalization there is in a business, the more stable the business is, and the longer its prospects for longevity, the longer it will be around. You know, if a bank is going to make a 5-year loan to you, you might show good cash flow today, but if you don't have good capital, if you don't have some equity behind that, can you sustain any losses? Can you show that you can handle a market downturn or some other kind of situation that might come up? So that's why it's important to look at capital. The last factor, how many C's are there? There's 5 C's. This is the last of them. It's kind of a catch-all. What else is out there, probably outside of your control, that can affect your business? Okay, it could be things in the economy. It could be new regulation that's going to affect what you're doing. New technology. This new technology, that's coming out all the time that might enhance your business, or it could challenge your business. Nobody's making buggy whips, or very few people. It used to be a thriving business here in the U.S., but nobody's making buggy whips anymore. What else is going on in your industry? What's the competition like? What are the trends that are going on? Is there a lot of consolidation that's happening that could affect what's going on? And what's going on in your local community? I had a business locally that, it was a retail business, back when I was a banker, and the city decided to have construction on their street for about 8 months, and that nearly put them out of business. Right? That's just an example, though. And your local bankers know what's going on in your local area. So, be aware of these different conditions that are going on, how they affect you, and be prepared to talk about that. Okay. So, the 5 C's: character, cash flow, collateral, capital, and conditions. They go into every single loan decision. A different bank might emphasize a different aspect of it. Some banks like more collateral. Some banks are more lenient on their capital. Some banks, will factor different things, but they'll all look at every single one of these to some extent. What happens, though, if you have a shortfall in some of these conditions, in some of these factors? All right, next slide. That's where the SBA comes in. Now, this is kind of an overall slide just talking about everything that we do, from government contracting to our business counseling. Leo did a great job talking about the different programs that are out there. Thank you again, Leo, for that summary. Next slide. I'm going to, the last of those items, capital, is where SBA really comes into play for what we're talking about today. And I venture to say that capital is what SBA is best known for, out of all the things that we do here. I'm biased, I'm a lender, so of course I think that. But we talked about all of those 5 C's, and you can see how these different factors of why businesses use SBA, how they factor into those 5 C's. Collateral is the number one reason, a shortfall is the number one reason that businesses or that banks need to use the SBA to get deals approved. If you're a startup, that means you don't have proven cash flow. Similarly, if you are having a business expansion, that speaks to your cash flow issues, all right? You're not proven. If you have new management, okay, are you of good character, right? A business acquisition, that gets into not just cash flow, but also collateral and capital issues. High-risk industries, those are the conditions that you're working in, the regulation, the technology, all of those. So you can see all of these different reasons that that businesses or need to use the SBA to get approved factor into a shortfall or a risk associated with those 5 C's. There are 2 reasons you might actually, and another thing about SBA is that you don't want to use SBA if you don't need it. You want to be approved on a conventional basis. But if you're having trouble, there's no other program out there that can help you the way that the SBA does. And there's even a couple of reasons you might want an SBA support on a loan. And that's because A, you can get a longer maturity on it. And what does a longer maturity do to your payments? It lowers your payments, all right? And you may not have enough enough equity into a deal. So, so you can really come in for it with a lower down payment sometimes. So these are a couple of reasons you might want to use an SBA loan. Next slide. We have three major programs within the SBA. Our Guaranty program, collectively kind of called the 7A, loan guarantee programs. Our 504 program is kind of a specialized program focused just on capital goods, buying equipment and real estate. And for our really much smaller deals, we have a microloan program. I'll talk about each of these programs briefly. And let me say also, it's not important for you to be an expert on the details of these loan programs. Leave that to the bank, leave that to the SBA to help explain that to the bank, all right? You can bring us into these discussions sometimes. Be aware that these loan programs exist. We're here to help you get approved when you're having trouble because of a shortfall in those 5 C's. Write this down, okay? If you're having trouble getting approved, okay, you need to ask the bank, can this loan be approved with SBA support? Write that phrase down because your bank and your banker may not automatically think SBA. SBA adds more work for the bank, more time and energy for the banker. Not every banker is willing to do that unless you ask for it, okay? It's up to you, if you're having trouble, to ask, can this loan be looked at with SBA support? It won't automatically be offered, all right? I'll get off my soapbox on that. Next slide. So the largest of our programs is a loan guarantee program. What does that mean? It means we provide a guarantee to the bank to kind of act as an insurance policy to them. If for some reason the bank or the business can't repay the loan or won't repay the loan, we provide the bank a guarantee that protects them to a certain percentage. We have, different programs carry different percentage levels of support and can offer different features, but basically all of our loan guarantee programs work the same way. The bank's not comfortable with the deal the way it stands. They need some additional insurance on the deal. They get an SBA guarantee, and that hopefully will make a marginal deal approvable. An SBA guarantee won't make a bad deal good, okay? I don't know any program that can really do that and any amount of structuring, but those deals that are on the edge, the bank likes it, but it doesn't fit their credit box. Something in there just doesn't work. The SBA guarantee helps that bank expand that credit box just enough, so hopefully you can get approved. Okay, it doesn't fix everything though. All right, think of it as if you've got a shortfall in one of those 5 C's, not counting character, nothing will overcome bad character. That's kind of a rule in lending and in life. But if you don't have enough cash flow, you don't have enough collateral, you don't have enough capital or your conditions are something that the bank's not comfortable with, and SBA can fix one of those things. It can't fix two of them. It might maybe two minor errors or shortfalls, but a major shortfall in two of those is probably too much for a bank. If you're a startup and you don't have enough collateral, that's probably too much. If you're a startup with strong collateral and a long history in the business, and you're putting in a lot of money into the deal, but there's, you're a service company and you just don't have enough. Different example. If you're a startup with all those other factors that look good, that's something the SBA could probably get approved. Okay. With our loan guarantee. So in the process is that you apply at the bank. All of our programs, we're not lenders ourselves. We work through the banks and the credit unions to get these programs approved. We're helping you get approved by your bank or credit union. So you always work with your lender. All right, next slide. Some of the things that you would use an SBA guarantee for: purchase equipment, start a new business, refinance your debt, working capital, needs, acquiring an existing business. There are a couple of specialty programs too, SBA Express for smaller deals. Export loan programs, that's actually what I do. If you are actually in the, in international, if you're an exporter, I've got some specialty programs over that. I'll just mention that at the end of these programs. Then our cap lines are lines of credit programs that we have. Next slide. Again, here are some of the basic parameters of 7A. It goes up to $5 million, all right? It has a guarantee of somewhere between 50 to 90%, depending on it. There's we don't tell the bank how much they can charge in interest, but we do cap it somewhere between, 2.25% and 2.75% over base rate. So it's up to the bank to decide the interest on it. It actually can be higher than this. This is actually closer to what the fees are. There's a fee to using our program, but but I always tell borrowers, if you need SBA, the fee can be financed. It can be rolled into the deal, and the bank's not allowed to charge another fee on top of it also. Okay. So it's not important that you know the specifics, but just know, but it doesn't hurt either. Next slide. The next program, I'm just talk briefly about these next two, is the 504 loan program. This is long-term financing for capital asset purchases. So if you're buying a big piece of equipment or real estate, 504 is the program you want to seek out, as opposed to 7A, okay, which you don't want unless you need it. 504 has some great advantages for you. First and foremost, it can really reduce your down payment down to as little as 10% on the deal. The basic structure is that the bank will do up to 50%. The SBA, working through what's called the CDC, can provide up to 40%, which means you can come in with as little as 10% down on these capital asset purchases. That's fantastic because that allows you to conserve your capital for other needs. It's also at very competitive rates, usually less than market rates on this deal. So this is a program that you want to seek out if you're buying equipment or large piece of equipment or real estate. It goes up to $5 million, 5.5 for manufacturers. Next slide. Lastly, I want to talk about of our major programs, the microloans. These are small loans, as you can tell by their name, made by approved SBA micro lenders. There used to be 5 of them here in the state of Michigan. I'm not sure how many there are now, but you can find them all on our website, sba.gov. These are deals that by their nature can't get approved by the bank even with SBA support. So these are more challenged deals. They go up to $50,000. They're typically term loans for 5 to 6 years. Okay, you'd work with your micro lender to get these approved, and there's always a level of support, counseling that's required with this loan. So that's a good thing that you want, because now you got somebody working with you hand in hand, making sure you're making the right steps on these deals. Next slide. So let me just take 2 seconds. I already said I'm the lead export finance manager for the SBA, supporting Michigan, Indiana, and actually Northern Ohio. We have a specialized program to help exporters grow their international sales. Next slide. I have a suite of specialized programs that carry a 90% guarantee, our highest guarantee, that can help you with your, with your international growth. That's all I want to say about that. If you need to, get in touch with me, and I can get into as much detail as you like. Next slide. That is everything that I have. Here's my contact information. If you reach out to APAC, they can also, provide you with this information too. But I guess I'd like to open up to questions right now from, everyone else that's on the call, to see if there's anything else I missed or they want to address.
Thank you, Romy. This was a lot of information, and I will include your contact information and some of the links, especially your SBA.gov links, in the description below. Thank you for joining us today for the Small Business webinar series. Please comment below with what you would like us to cover next. Like I said, I will include Romy's contact information in the description below. I want to thank Laura, Romy, APAC's Small Business Action Committee, and General Motors for making this possible. Thank you, everybody, for joining us today.